Hello and welcome to this edition of Closing Trades right here on ET Now with me, Aisha Faridi. And for the markets, the range movement continues, although there have been some attempts to try and scale back. Right now, we're sitting in the green at about 70 points higher above that 25,200 print right now. It's banks, to be fair, they were the ones which saw the first signs of a pickup well within the first hour of trade. And then from there, it's now auto, chemicals, capital goods, some of the select pharma names as well, which too have picked up. But still a lot of uncertainties with regards to tariffs, the kind of repercussions and ramifications it's going to have for global growth, and of course, how India is positioned within that piece. So let me welcome on board Florian Neto, CFA, Head of Investment Asia at Amundi, joining in on the show right now. Florian, good to have you on ET Now. Thanks for your time today. Let's first talk about the tariff impact on Asia, because, I was just going through your recent note and it mentions that macroeconomic impact on US tariffs on Asian markets has been limited so far. But tell me, how are you at Amundi adjusting your Asian investment strategies to try and prepare for a potential escalation perhaps in US-China trade tensions or broader tariff policies?
Yes, thanks for having me. Indeed, the situation is quite fluid. Almost every day you have a news related to tariff with a number associated to it. So I think we try to take a step back, assess a bit the long-term growth we're having in the countries, the monetary policies that is very much at easing everywhere in Asia. But if we dig back into the tariff level, after a few days where the US administration has been extended the deadline to August 1st, but at the same time, penciled down some deals with countries in the region, what we can see is that, one, you will have an aggregated effective tariff rate that is higher than what has been initially anticipated. So for now, you're right to mention that the market has been looking through it, but we do believe there will be some impact in terms of GDP growth for the second half, and there will be as well some revision lower for EPS in general, not only in Asia, but just because the level of tariff will be increased. The second point we are looking at very cautiously is the fact that there have been some measures in the UK deal, in the Vietnam deal, that are linked to sidelining China, especially it has been mentioned about transshipment. It's not only China, but we know China is the main target for the US administration related to transshipment. For Vietnam, South Korea as well, companies are very much involved in it. But in general, what we are sure of is that there are some measures that will be as well in other countries, deals signed with the US, that are trying to put China in a complicated situation in terms of transshipment. The methodology is not clear. Is it a supply chain diversification or if it's a pure transshipment? And it has very wide impacts. But in general, we do believe that despite the fact that we have tariff, and despite the fact all things being equal, it's a bit deflationary in Asia, and you will have a slightly lower growth and lower EPS expectation. We do believe that Asia equities are still relatively appealing in the global portfolios. And we are as well positive on Asia bonds in local currency because we have the dollar as well that is in a structural bear market. And we do believe that tariff can help the dollar over the short term, but we are in a structural bear market there.
Right. But Florian, you were highlighting a constructive stance on Asian rates and duration, particularly favoring quality investment grade or IG corporate credit. Which specific Asian markets or sectors do you see as offering the best opportunities for IG bonds, and why?
Yeah. So first, the background. The background is we have disinflation confirmed in Asia. We have central banks that have been entering into a prolonged monetary policy easing period. RBI has been surprising with 50 basis point cuts as well in June. So and the background as well is FX has been resilient. So this is not something common. So we have a break in terms of correlation a bit between what's happening on the Asia central bank side and what's happening between Asia FX and US dollar, especially the low yielder FX. So in general, we tend to prefer the IG versus the high yield, as you mentioned, a bit high quality. We are turning a bit more high quality. Why? The first one is the risk reward we're having on high yield right now is a bit less appealing that we can have maybe 3-4 months ago. spread have been tightening quite significantly. So in general, we prefer to be in cash earner issuers that are of a good quality. When we dig deeper into what kind of sectors we like or what kind of country we like, we do believe that it's important to keep in mind the FX and our view on the underlying FX as well. When we go into Asia, IG in US dollar, when we go into hard currency, this is not a big issue. But when we are going as well into credit in local currency, we do prefer areas where we are positive on the currency. And those are Indonesia rupiah and India rupee. The recent move we're having on FX is we like as well Korean won and we like the renminbi. So we have been reducing our underweight, and we do believe that those low yielder will be more resilient than initially expected. In the high yield space, the ones that we remain quite committed to is the India renewable space. So we have been participating into new issuance in that space, and we are having another weight in our portfolio. Apart from this, we like the tech on the China and on the Korea IG. So those are basically the ones that we like the most currently in our portfolio in terms of issuers in the investment grade space in Asia.
I want to talk about specifically, when it comes to China, because you remain neutral on Chinese equities because of the issues like housing market weakness and deflationary pressures as well, which persist. What specific domestic opportunities in China are you at Amundi exploring, and what would it take for you to shift to a more positive outlook?
Yeah. So on China, I think if we take a step back, you look at the 3-year period and you see that China has not been rewarded, to say the least, in relative terms. In year to date, China, and especially offshore stocks, are very strong performer, more than 20% performance for MSCI China. So you did mention about the structural issues, rebalancing issues at play in China currently, and they are very much clear. Supply overcapacity, and you mentioned about the deflationary, especially in the private sector. The residential real estate, we had some positive feedback loop on tier 1 city at the beginning of the year, and now it's a bit more under pressure again, so it's weakened again. It means that the period of healing will be longer on the real estate. And we have as well the fiscal stimulus that has been, to say the least, below expectation in terms of delivery. The powder is still dry there. And we do believe that the administration, the authority, will step in with a more decisively fiscal stimulus. But for now, it was not necessary, or it was not perceived as the first priority. So when you mention about where we see some opportunities in China today, so we are neutral, but we have actually a barbell approach. We like specifically offshore versus onshore. Why do we like offshore? So basically H share. And we do believe that there will be a prolonged momentum. The first one is supported by steady southbound flows. So mainland investors in China are investing heavily into Hong Kong quoted Chinese stocks, and we had record high flows in year to date. The second point is we have a very strong and abundant liquidity in Hong Kong. To defend the peg of the Hong Kong dollar versus US dollar, the Hong Kong Monetary Authority have been reducing rates, pouring a lot of liquidity. They are now withdrawing liquidity progressively, but they want to make sure that what we see in Hong Kong in terms of real estate recovery, what we see in Hong Kong in terms of flows coming in, is not basically put on the sideline. So they are very cautiously withdrawing liquidity. It means that when you look at HIBOR 1 month, you still are below 1.5%. We see more than 3% difference with the US dollar. And with a robust IPO. So the pipeline of IPO has been very strong in year to date. It was not the case for the last 4 years, and Hong Kong is at the top of the board, well ahead of London, for example. And on H2, we have more than 100 companies, not only Chinese companies, actually, you have as well companies in Asia, other Asian companies, non-Chinese, that want to get quoted in Hong Kong. So all this means that we are very happy to be long offshore Chinese stocks, and especially we like the tech platform. Then when you mentioned about when we will turn more positive, we will turn more positive, and it will be through A shares, so mainland Chinese stocks, should we have a bit more news on the fiscal stimulus. We do believe that if the authorities are serious about the 5% GDP growth for this year, they will have to move more decisively, especially that what we are seeing on the real estate side is not very positive. And knowing all the different context in terms of trade and tariff at place. So you cannot rely heavily on trade and export that it was the case over the recent years. When you think about consumer and all the stimulus stocks, it will be on A shares. So for now, we have a bit of consumer stocks in China. We are neutral and in general slightly underweight on some, and we will turn more positive should we have a probability of more fiscal stimulus increasing over the coming months. And we do believe it's a Q4 story. It can be even earlier, but in Q4 we will increase further a bit the consumer name we have in A shares. So for now we have technology in H, where we are overweight. We have some consumer names in A, but we have more powder to increase, and the rest is very bubble because we have high yielding stocks to make sure that we don't have a very high beta on Chinese equities right now.
Sure. Florian, I want to talk about India's growth potential as well, because you've been very optimistic about India, citing policy easing and growth surprises. How are you positioning your portfolios to capitalize on India's growth, particularly when it comes to sectors like consumer staples, communication services, and of course, real estate too?
Yeah, indeed. I think first, in terms of strategic views on India, we are very positive on India. It's a structural growth story, and we have been increasing further our GDP expectation for 25 and 26 last months. So the growth premium of India versus other emerging economies is increasing in our view. Over the last years, what we've been doing as well is we have been reevaluating our global and Asian strategic asset allocation to make sure that India will receive a structural higher exposure, higher weight in our portfolios. We will not come back why India and so on, but I think more tactically, what will be interesting to see if India can benefit from the China +1 relocation, and especially on the manufacturing sector. We know that India is very much at the forefront and leading on the services side, but they can do a bit more on the manufacturing side. So this will be interesting. The fact that from a geopolitical point of view, India is very much non-aligned, as said, is perceived as a strong advantage versus the neighborhood equity markets in investor views, because we are right in the middle of the current trade reshaping, and we do believe that the deal with the US will be announced in the next days. So I think it's just a matter of president signing the deal, but I think it's well advanced. From a portfolio construction, the way we are perceiving India as well is slightly different within an Asian portfolio or a global portfolio, because it's very high quality stocks that are not very cheap, but it's normal because it's the quality you need to pay a price for the quality you get in the portfolio. So from tactical, we are not that overweight on India. Actually, we are neutral from a tactical point of view. We have skin in the game strategically, but tactically, what we've seen on the earning revision side, we have been seeing initial sign of bottoming out of some earnings revision across sectors, but that's not been improving as much as what we are seeing in other EM economies and other EM companies. Foreign investor flows after leaving the countries for 6 months, and this was quite clear, right, from September last year to March, have been coming back, but they have been coming back relatively moderately. So where are we ending up now? We have a stable EPS growth in India. Our view is we will be around 14 to 15% for 2025 full year. But we would like to see confirmation of more private capex before increasing further our stake. You did mention about some sectors. We do like consumer services, but as of today, we try to be quite cautious and have a slightly underweight position on pharmaceutical areas in the country.
Right. But what about India's equity valuations? You think they may become a hurdle because of the recent re-ratings? And how are you navigating these high valuations in India equities and maintaining a disciplined investment approach?
Yeah, I think it's true. It's a concern. It's one of the major concerns is the valuation. But as soon as earnings delivery is there, you can see that as well in the US, where you have a lot of growth stocks. You can leave with higher valuation as soon as you are delivering on earnings. For now, what our main issue here is the fact that private capex has not been very coming back strongly, and we do believe this is the main way of delivering more earnings going forward. So it's always having a view on the sector, and then you look into bottom up. And we are not particularly concerned about the valuation. We do have some concern on the mid cap, but on the large cap, we do believe that as soon as the earnings revision is moving a bit higher and the company is able to deliver a bit more, and I think having the dust settling down a bit with the deals that will be announced soon between India and the US, then you can reassess a bit more what we have in mind in terms of delivery, and this will not be a big issue. I think we can live with a bit temporarily more expensive valuation as soon as earnings is coming back and you don't have a pure re-rating.
Right. But what about, policy easing and growth surprises here in India? Tell me, how is it that you're adjusting your fixed income and equity strategies to try and leverage the potential interest rate cuts by the Reserve Bank in the remainder of the year? And which Indian bond or equity sectors look most attractive to you?
Well, I cannot enter into too many details on the India bond side per se. We did add some SSA that we do believe are quite appealing in this environment where RBI is cutting, and we do expect that RBI will cut more into the second half of this year. So we add some SSA that are quite appealing in terms of portfolio construction and high carry in our portfolios. We do commit more into India renewable bonds as well, where we see some very strong investment proposition versus the other part of Asia high yield right now. So where we have still some good carry when the spread are not super tight, but when we have the RBI behind that is making sure that liquidities will be pouring and the monetary policy will be more accommodating. So when we look into the difference between fixed income and equity allocation in our portfolio, in this current environment where you are in a rather late cycle and growth is decelerating, but earnings are relatively maintained, and in India it's a double-digit earning per share that is expecting for this year, it's an area where you want to be long equity and you want to be long duration. And so this is a period of time when we like both areas in our portfolio, and we are overweight duration in India and overweight as well India equities. On the tactical point of view, we are just neutral on India equity, but on Asia equity, we are overweight.
Florian, I also want to talk about the geopolitical risks, because with rising uncertainties such as Middle East conflict potentially affecting oil prices and supply chains, how is Amundi managing these risks in Asian equity and bond portfolios? Yeah,
indeed. So if you look only into company fundamentals, you will miss a lot of what's happening on the market and as well on market prices. So when you look back into the company's share price, you may not find all the reason back into fundamentals. So what we've been doing is, one, acknowledging the fact that economic warfare is at play. And it's increasing in the recent years. So we've consistently seen level of protectionism, level of export control, level of sanctions that have been increasing, and U.S. administration of late has just accelerated further this trend. Economic warfare most of the time can as well evolve into war, and this is what we're having in some very hot region currently. So what we've done on our side, conscious of this, is to develop our proprietary geopolitical sentiment tracker. And this is something we are monitoring on a weekly basis, and we are taking decision on a monthly basis as well. And when we look into it, you see that you have some spikes currently on the geopolitical sentiment tracker, while the market is looking through it purely. Of course, you've been seeing a bit oil price moving up, but they're coming back down very quickly as soon as you have a few news on Iran, for example, or as soon as you have OPEC increasing a bit production. So you do believe that supply then is moving up, and then the market is looking through it. In our view, the main geopolitical issue we have currently is a tariff, and the tariff impacts will be delayed, not derailed. So this means that economic growth and earnings will be moving down in H2. So what do we do from an investment perspective to take into account this news is the fact that we don't want to fight the momentum in risky assets, but we acknowledge the fact that geopolitical sentiment tracker is moving up and the market is not pricing a risk premium on this one. So we have been reinforcing last week again some hedging in our portfolio. So how do we do this? The best way to do it, in our view, is via optionality currently, because as the market is not pricing for it, implied volatility, especially on equity indexes, is relatively cheap. It's cheaper than average over the last 5 years, while we do perceive that there is more risk than before of an economic deceleration that will be a bit faster than expected. So it's not the central scenario, but it's something we need to protect ourselves from, knowing that we have been performing very well in the first half of this year. So you need to protect as well a bit the performance. You can still go into and expose yourself to safe haven currencies. We do prefer Swiss franc at this stage in our portfolio, and we still have an overweight on gold in our portfolio. Apart from that, in our selection on the stock side, we do prefer domestic and stocks that are more highly, I would say, benefiting from domestic demand and not relying extensively from foreign demand and trades in our portfolio. So basically, that's why we have more Philippines exposures than before in our portfolio. We have a bit more China A compared to what we would have expected from a pure top-down point of view, just because we want to make sure that we have a bit more domestic play that will be more resilient should the geopolitical and tariff-related risk premia start to be priced in a bit more decisively on the market.
Right. And, your report has been very constructive about emerging market bonds and equity markets like Mexico, Peru, Hungary, and also highlights India and Korea in Asia. How do you balance your exposure across these diverse emerging market opportunities? And what role does Asia play in this broader EM strategy at Amundi?
So if you look into EM strategies, it's true that the carry is not there. It's not very much in Asia. And you have a lot of different spaces as well where you can find more appealing carry, but more volatility as well. In general, in our Asian portfolio or in a global portfolio, then India or even Korea bonds that you mentioned are taking very much sense. So first, I think we are currently having some flows coming back to the asset class. So Asia local currency bonds have been recorded a foreign flows in year to date over 40 billion in US dollar, which is massive because it's part of a more structural change of, I would say, US dollar erosion as a safe haven asset. So this is quite interesting to see that. I would say from a portfolio management point of view, what is more important for me is to make sure that the correlation and the diversification I'm expected are eventually there. And we see unstable correlation with US dollar weakening in front of a steepening of the curve in the US or US dollar weakening in front of the drawdown on the US equity. And then I have an unreliable diversification. So this is one of the strong value creation, I would say, of having some currency bond in the portfolios that are in local currency bonds in the portfolio from emerging markets. Then, if we look into how can we play safe haven in a portfolio, knowing that we have fiscal deficits that is a commonality across various developed economies. So we are talking very much about the US with the beautiful bill that will eventually increase fiscal deficit in the US above 6%. But it's very much something that we are seeing in Japan and very much something we are seeing as well in Europe. So the fiscal deficit is increasing drastically on developed market curves. So if you manage a global portfolio, you need to find other areas that are potentially protected from further downgrade and that are having a fiscal picture that is improving. In that aspect, India or Indonesia curve are very strong candidate. Those are not safe haven per se because the rating is lower, but at the same time we see some fiscal consolidation there that is quite appealing and more than before, knowing that G7 exposure would have to be potentially reduced. When we look into Korea bond and Chinese bonds, those are more high rated, low carry. But now that you have a local FX that is way more resilient than before, you can definitely go back into the Korean curve or the Chinese government bond curves, and you ask yourself, would I have monetary policy easing going forward? Yes. BOK skip one, but eventually open the door for more cuts down the road. Same for China. We do believe that we'll have even more accommodative monetary policy, while they have been already delivering quite a lot. If you hedge back the currency, to come back to US dollar, you have actually a similar to higher carry than the US curve. So what is interesting to answer to your question is that you have in Asia and from an emerging market perspective, but as well as global market perspective, the two areas you are looking for when you are a portfolio manager. You have the relatively safe haven curve that can play an alternative to G7, and those will be Korea or China government bond curves. And while you still have some good carry and good appealing opportunities with fiscal consolidation in India and in Indonesia, where we're happy as well to carry the currency underlying.
Right. Florian, so good having you on the show today. Thank you for your time and great insights and food for thought. Okay, on that note, we're going to